The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A tinge of optimism returns to the street. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. It's like, what, yesterday never happened?
Yeah, pretty much, but wait till tomorrow.
Wait till tomorrow. No, it's a fair point. Now, to that point, you take a look at the S&P, right? Now, if we close above the 6071 level, that's where we closed last Thursday. So for the S&P, we haven't yet made up that decline over the last 2.5 days. But the VIX, definitely calming down to 17. The 2-year yield now coming in lower, about 3 basis points. That has basically evened out over the last 3 days. Gold, though, continues to go at a record, Romaine. So there's still that safe haven buying in there, even if equities have made semi-round trips.
Yeah, I like this board because we don't want to poo-poo the moves that we are seeing in stocks, but there is sort of, when you look at the chaotic approach to U.S. trade policy, there is still sort of a cap on risk sentiment right now. You saw that with gold. Bond volatility remains elevated. Implied volatility for the dollar still sits well above its 1-year average. Treasury futures seeing strong buying demand for a second day. And in equities, the strongest bids are to individual stocks to the strongest companies, the Apples, the Nvidias, the Amazons, and the Metas.
I think in the U.S. you have an abundance of long-term growth stories that can be somewhat insulated from these tariff noise.
And maybe that's what investors are looking for. That noise has been lowered to a hum from a din for now as Canada and Mexico negotiated a 1-month reprieve from those new tariffs. But the specter still looms. And that promised phone call between Trump and Xi has yet to happen. Calvin Klein parent company PVH now on China's blacklist. So too is gene sequencing company Illumina, and Britain's Diageo, which gets at least 40% of its alcohol sales from North America, scrapping its long-held sales target. CEOs on earnings conference calls today peppered with questions about how they're preparing for an escalating trade war. Now, more of those questions likely to be pitched at executives tonight when a flurry of earnings across a swath of sectors crosses after the bell. While tech heavyweights like Alphabet may be able to weather the trade tumult, other companies reporting, like Cirrus Logic, AMD, Mattel, Mondelez, and Chipotle, they're living in a different reality. Juggling worries about tariffs, juggling worries about high interest rates, and juggling worries, Alex, about still stubborn inflation.
And all of that leading to continued worries about inflation. Morgan Stanley just actually moving their Fed call to 1 cut this year in June instead of 2. And this chart kind of illustrates why. So the orange line is the 2-year break even. The white line is the 5-year break even. This is over a year time period. And right here is where the election happened. And ever since then, the 2-year yield has continued to climb. A 2-year inflation expectation, I should say, continued to climb. And it got a really big spike at the end of last week as well. So you have higher inflation expectations now. You have Fed cuts being dialed back for this year. And you saw that reflected very much in the bond market yesterday with selling of the front end and buying of that long end, Romaine.
Absolutely. Let's get right to it with Kristina Campmany, Senior Portfolio Manager of the global debt team at Invesco. All right, what is the bond market telling us right now?
Look, I think we're juggling two different things. I think there's definitely a flight to quality element, and you saw that yesterday, I think, with the twist, and that there's a bid to the front end. And we kind of look at it and we say the front end's pretty perfectly priced here. We're flat to policy rates. There's value there. And then I think the long end will kind of wobble between the, if you have flight to quality bid, as we're all digesting these headlines that are changing minute by minute, and the reality of, do we have softer growth coming down the pike? Do we have more inflation? Do we need to build in term premium for all the supply that's coming?
And all of this seems to link back to the White House, and we should point out to our viewers, we're waiting to hear from President Trump yet again, more executive orders and more commentary on some of his trade policies. How does a market sort of react to something that is almost unreactable because you don't really know what's coming next?
Yeah, I think the known is that we all are dealing with a world of uncertainty. And I think from the time that we got the election results in November, we said, what are his biggest priority initiatives? It seems to be immigration, tariffs, taxation, and deregulation. What order do we get them? What's the magnitude? How quickly do we get them? We were saying earlier, we're only on day 14 post-inauguration, right? It's been fast and furious. I think we still need time to digest what will be the impacts of these, right? Like we're seeing much bigger headline tariff numbers, but then they're on pause already. So we've had a lot to digest. I think we have to wait, and it will take some time to really see how it flows through.
And also initial reaction can change, right? I mentioned that at the top, right? The S&P is almost circled back to where it was at the end of Thursday. The 2-year most definitely has. We were right at where we closed on Thursday afternoon for the Treasury market. So how do you do an investable thing and a trading thing in the Treasury market right now?
So I think there are kind of what do we know and what are we waiting for? And I think in terms of our anchor from here is we think that the front end offers value because we're at flat to policy rates. We don't have negative carry to own front end assets. And then we can structure portfolios around that, whether it's mortgages or a short duration, corporate bonds, double B corporate bonds look interesting, those kind of things. I think out the curve, it becomes a lot harder. And I think we're all sitting here and saying, 3 months out, 6 months out, what are the impacts? Is it, do we have labor market impacts because of immigration? Is the biggest tariff impact, is it a growth negative or is it an inflation shock?
Right. And how do you weigh it? Like it could be both, but then where do you weigh it the most? So then when do you wind up taking into account issuance? Because we get the Treasury refunding announcement tomorrow morning. It doesn't look like there's a lot of change in terms of how much borrowing, but when does that start to matter?
So I think over the last number of years, the U.S. exceptionalism story has continued to draw money into the U.S. because there's no other market like it. And I think we, as the U.S., as an issuer, kind of continue to benefit from that. If you just look at the amount of supply out there, the curve should be steeper. But we haven't kind of gotten there. And I think the push and pull in the long end will be, is it the fear factor, concerns about what the downside is, that has a flight to quality bid, or is it building in term premium? So,
I'm sorry to cut you off, but I am curious about what your expectation is of how the Fed sort of factors into this. We've already heard from a couple of Fed members, including Bostic, Daly, I think Collins as well, also kind of sort of indicated that they're willing to just kind of wait and see here. Just today, the team over at Morgan Stanley lowered their outlook for Fed rate cuts to just 1 this year.
I think the clearest option seems to be kind of a 6-month waiting period. We know that the Fed kind of historically, 1 data print doesn't do it. 2, if it's 2 in one direction or another, they start to get worried. And 3, they normally can react on. We're coming from, if you look at the labor market data, and we have payrolls on Friday, the last 3 or 4 numbers have all had these noise factors, whether it's the hurricanes, now we have the wildfires, there's been all these bits and pieces. The inflation numbers, we have all of these policies that are now being put into effect. So even to say you get the 1 inflation print, can they react to that? I don't think so. I think June is probably the soonest that you can really talk about what we do. And I think the Fed can comfortably sit and say, we've delivered 100 basis points of easing. We know that there are lags. Let's wait and see what we get. And we don't want to buy into being political organization. And we're going to do what we can with the real data when we get it.
All right, Kristina, great stuff. Great to have you here to kick us off to the close. Kristina Campmany, Senior Portfolio Manager of the Global Debt Team at Invesco. Stick around. We'll be right back. Let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start with Juniper Networks. Evercore ISI upgrading the communications equipment company to outperform. The analyst says that while the U.S. Justice Department may be threatening that deal to merge with Hewlett-Packard Enterprise, Juniper will still be just fine without it. That's given the company's potential for margin expansion and cloud services. Those shares up 2.5% on the day. Next up, Palantir raised to equal weight at Morgan Stanley. The price target bumped to 95 from 60 after last night's earnings report. The analyst touts the strength of Palantir's outlook, driven by demand for both its commercial and governmental units. Those shares now at a record high. And finally, AMC Entertainment, an upgrade to neutral at Roth Capital on the belief that the share should be at or near a bottom. Movie box office should be entering a positive 2-year content cycle, to which the analyst says could help AMC return to positive cash flow. The meme stock, which has basically been flatlined for more than a year now, after plunging from $388 a share, up 3% to $3.17 a share. And those are some of our top calls. Now, one company that is reaping the benefits of a positive box office cycle is Walt Disney. The media and entertainment conglomerate will release its first quarter report tomorrow morning, and investors are eager to hear more about that streaming business, as well as whether Disney theme parks were able to bring the magic. Ben Swinburne joining us right now, head of U.S. media research at Morgan Stanley. He's got an overweight rating on the shares. Number one thing, Ben, that you're going to be looking for out of that report tomorrow morning.
Well, thanks for having me, Romain. I'm really focused on the experiences segment, to your point about the parks business. This is over a $30 billion annual sales segment for the Walt Disney Company. It's almost 2/3 of their earnings base. We know there were some hurricanes in the fiscal first quarter. They're going to pressure results, but really focused on the forward outlook. In particular, how they're going to compete with the new Epic universe from Comcast coming to Orlando in May.
So is that a real threat? I mean, when I think about Disney and the parks specifically, I mean, they almost seem kind of like this just singular thing on their own. Look, I know there are other parks, particularly in the Florida area, even in California, but I don't know, anyone with a kid knows nobody raises their hand and says, take me to Universal Studios. No offense. They say, take me to Disney World.
None taken. And look, I generally agree with you. I guess what I would say is I think investors are concerned. I mean, Epic is the biggest new opening in the Orlando market in decades. And the reality is that Disney's parks performance in 2024 was a bit disappointing. So the company expects improvement through fiscal 25. We actually think they could outperform expectations, in part because of some new cruise ships coming to market. But the stock, we think, has been stuck a bit as a result of concerns over competition and last year's performance. So that's why we think tomorrow could be a real positive catalyst for the stock. If the company's able to deliver good numbers and give some conviction to their outlook.
I'm sure they're going to say they love the competition. It brings more people, et cetera. I'm sure they're going to spin that way. Hey, Ben, let's talk about streaming for a second. What would be a good enough growth in streaming?
Well, last year they made money in streaming for the first time since they got into that business, $1 billion of EBIT. We think there's real opportunity for upside in 2025 relative to expectations. They guided to a slight decline in Disney Plus customers in the first fiscal quarter, but they did have some very big films from the summer and fall come onto the service. Think about Deadpool 3, and obviously at the box office had a really strong performance over the holidays, particularly with Moana 2. So a positive number would be good, Alex. And obviously, as we look ahead, we think there's real opportunities for them to grow that business double digits on the top line moving forward.
Deadpool Wolverine, it's like my favorite. All right, Ben. Who do we compare Disney's streaming to? Because we can't compare it to Netflix, right? They're already 2 to 5 years behind Netflix, so that comp is not going to be good for them. Well, what's a good comp to see if those streamers are good enough?
Yeah, I think it's a great point. I mean, Netflix is in a world of its own for sure from a scale point of view. But, for Disney, we think this could be their fastest growing earnings base. And if we go back to sort of big picture, what is the Walt Disney Company? Historically, it's been a media company that has built its earnings base on traditional TV. That is no longer the case as we think about today and over the next 3 to 5 years. It's first and foremost experiences, and then secondly, streaming, particularly as we look out over the longer term. So when we think about double-digit earnings growth starting in 26 and hopefully getting into the teens, the biggest driver of that growth rate is going to come from scaling Disney Plus and their streaming business.
So is this idea here that all of this sort of connects together? And the reason why I ask is there's been a lot of discussion, and I think to a certain extent, in fairness, I think Bob Iger has kind of pushed back on it, but there's been a lot of discussion on Wall Street about whether some of these businesses should be split off, basically to kind of stand on their own. I was always under the impression that kind of the whole was almost better than the parts.
I think in general, you're right. In fact, I often may take the view with investors that the primary way Walt Disney monetizes its iconic brands and franchises is actually through the parks, through that physical manifestation of the IP and experiential assets, which we think have long-term secular growth tailwinds to them. You think about making movies and monetizing them and distributing them in the box office, you distribute them and monetize them through streaming. All of it does fit together. I think one of the most interesting areas of sort of debate as we look out through the rest of this year is the sports piece and ESPN, which is getting to be a smaller part of the earnings pie. But sports is so important to the U.S. consumer, global consumer. And so figuring out how ESPN fits or doesn't, I think, is a big topic.
Hey, Ben, thanks a lot. We really appreciated Ben Swinburne joining us over from Morgan Stanley. Thank you very much. All right, coming up, we're going to speak to former New York Fed President Bill Dudley about his latest Bloomberg Opinion piece, talking about how Trump's tariffs are even worse than I imagined. More on this on The Close on Bloomberg. Well, President Trump agreeing to delay those 25% tariffs on Canada and Mexico for a month and is set to speak with President Xi of China very soon. In his latest Bloomberg Opinion piece, former New York Fed President Bill Dudley writes that tariffs on Canada and Mexico will deeply damage an economic ecosystem that has helped the U.S. remain globally competitive. Bill Dudley joins us now with more. Bill, we really appreciate your time today. Do you feel like the effect will be felt more on the inflation side or the growth side?
Well, first of all, we don't know what's going to happen, but assuming the tariffs are enacted in full, say a month from now, the effects are going to be both sides. We're going to have higher prices and lower growth because everything's going to be more expensive. And also the tariffs are going to disrupt supply chains. So that's also going to lower productivity growth. The key thing about which one predominates prices or growth is whether the increase in the price level caused by the tariffs gets into people's views of inflation on an ongoing basis. Mm-hmm. If inflation expectations stay well anchored like they did in 2017, 18, and 19, then the Fed can look through that increase in the price level and focus on growth. Mm-hmm. But if the price level increase gets into inflation expectations, then that's a much more difficult situation. And the situation is obviously different now than it was back in 2018 and 19, because then inflation was running below the Fed's 2% objective. We've been running above the Fed's 2% objective now for over 4 years.
And that brings me to something we brought up earlier in the show, is that 2-year inflation break even. That has been rising since the election. So if I'm looking at that just around 3%, and you were still at the Fed, how would you be understanding that?
Well, I'd be trying to figure out if this is a one-time blip or something that's going to last a lot longer. There are also measures of inflation expectations that look at long-term inflation expectations. For example, you can look at the spread between TIPS and nominal Treasury securities and calculate the inflation expectations 5 years from 5 years to 10 years forward, and that really hasn't moved very much. So that's the one that the Fed's going to be focusing on, is really the long-term inflation expectations rather than the short-term. To the extent that tariffs are going up, we know that prices are going to go up in the short term.
Is there sort of a case, though, to be made when we talk about what Trump is doing, or at least what he's publicly said he's doing, that it can balance out? And I asked that in the context that he was kind of asked specifically about the economic impact and asked specifically about the market impact. And he seemed to suggest that the issues that he says he's trying to resolve are also having an economic drag. And he's basically trying to find a balance in between the two.
Well, I suppose you could make that argument, but I mean, the case of the 25% across the board tariffs put on Canada, what did Canada do to deserve that? There's not a lot of illegal immigration from Canada into the U.S., and the amount of fentanyl that seems to be coming across the Canadian border into the United States is de minimis. So that seemed more of an excuse to hit Canada with a 25% tariff. I mean, I think the big problem with 25% tariffs on Canada and Mexico is they're part of an integrated economic trade zone. The onshoring, friendshoring that's been taking place over the last 10 years has really integrated the Canadian and Mexican economy with the U.S. economy. If you all of a sudden you put 25% tariffs in place, you're blowing up that economic integration, which has actually had quite a few benefits for the United States.
Well, yeah, I mean, let's face it, with these 25% tariffs, I mean, Trump is effectively ripping up his own U.S. North American trade deal, which, of course, he ripped up the previous one prior to that. From an economist standpoint, and specifically from a Fed economist standpoint, we've heard from several members over the last few days, Daly, Bostic, Collins, and I think a couple others, who've kind of made it clear that they are just going to wait and see, that they really want to see the whites of the eyes of inflation before they react. And I'm going to put this delicately, but is there a case to be made for the Fed to be more proactive?
I think it makes sense for the Fed to wait and see for two reasons. Number one, they think that policy currently is restrictive, so waiting and seeing is at a restrictive setting. So that's also exerting some downward restraint on inflation. And two, we can just see how quickly things that can change. I mean, in the last 48 hours, gone from 25% tariffs on Canada and Mexico, going to be implemented immediately, to a 1 month hold, and we'll see what happens when that time period expires in early March.
So how quickly can this pass through to the actual consumer and to those expectations in your history and studies?
pretty fast because, as soon as someone knows that the cost of the imports that they're bringing in are going to go up significantly, they're probably going to start raising the prices on the shelf, today because they know they're going to have to replace those goods with more expensive goods. So I think there's also going to be hoarding by consumers. I mean, if you know the price is going to go up in the future, you're going to try to buy today. That's also going to give more, pricing power to the person selling that product. So I think that it won't take very long for higher tariffs to get into higher prices.
All right, now I'm sure your favorite question. We're looking at about 34 basis points of cuts priced into WIRP here on the Bloomberg Terminal, World Implied Interest Rate Probability. We had Morgan Stanley just say, you know what, one cut this year, not two, and that's going to be in June. Does that make sense? We're looking at one cut now?
Yeah, I think that makes sense. I mean, I've been in the higher for longer camp for a number of years now. And, my thesis is that, the interest rates aren't really exerting that much restraint on the economy. The so-called R-star, the neutral real interest rate is higher than it was in the last decade. And we can see that by the fact that the economy is doing fine, even though monetary policy is seemingly restrictive. So I think, and with the uncertainty particularly high, and the tariffs likely to push up prices, it seems like waiting is the right strategy from the Fed right now.
I do want to go back, Bill, to this idea of balance. And I want to sort of draw upon a column that you wrote, I think it was either last week or the week before, about some of Trump's economic policies. I mean, we kind of be remiss in pointing out we're only 2 weeks into this administration. There's a long laundry list of things that Trump said he wants to do, and this only appears to be part of it. We talk about tax cuts, which of course would have to go through Congress, extension of tax cuts, which would have to go through Congress, and other economic measures. And I do wonder if you see any potential upside to those policies, assuming that they do become reality, that could blunt the impact from an increase in tariffs.
Well, the thing that people point to is that Trump has said he's going to deregulate, and if the deregulation is done thoughtfully and carefully, that can obviously, reduce the costs for business and raise productivity. But figuring out what regulations to do without endangering people, that's more difficult. I mean, the regulations are there for a reason typically, and often the reason is a good reason. For example, think about drug safety. So that's the part of the story that I think that gives people in the stock market the most positive feeling about. If they're deregulation, productivity growth will rise, profits will rise, and that'll support the stock market.
How much confidence do you have right now in the FOMC, not so much to make the right decision, but also, as we know, to maybe resist some of the pressure that they might be getting from the White House to make decisions that maybe would be otherwise against their own traditional policies?
Well, obviously, the Fed will do the best job it possibly can and will not be responding to political pressure one way or the other. They'll do what they think is appropriate to achieve their objectives of maximum sustainable employment in the context of their 2% inflation target. And that's what they're going to do. That's what they have done. That's what they've always done. That's what they'll do going forward. At times, it may look political in the sense that the president wants them to cut interest rates and the Fed doesn't do that. But it's not because the Federal Reserve is trying to be difficult with respect to the Trump administration. Yeah. If they don't cut rates, it's because they think it's not appropriate.
But there seems to be a much different complexion to Trump 2.0. We've been talking a lot on this network all day long about whatever the heck's been going on over at the Treasury Department with some of the guys, and they're all guys that Elon Musk sent over there to root out whatever the heck he wants to root out. We've seen other measures in some non-economic areas like USAID and a few others. Why am I to believe that the Fed would somehow be immune or safe from that?
Well, I think the Fed is going to come under scrutiny for, its expenditures. I think the Fed will come under scrutiny for whatever it's doing in terms of diversity, equity, and inclusion. So I think the Fed will, and I think as a result, the Fed will be very careful about how it proceeds in those kind of areas. I would expect the budget at the Federal Reserve is going to be very austere over the next few years. I think the issue, though, about what's happening at Treasury is a much bigger issue, which is Congress is the part of the government that makes the expenditure rules. Yeah. And it's not up to the president to decide whether that money appropriated by Congress gets spent or not. So I think this is going to go to the courts.
All right, Bill, we have to leave it there. Bill Dudley, we thank him for his time. Bloomberg Opinion columnist and, of course, former New York Fed president. Let's go down to the White House right now where President Trump is speaking.
Man. Okay.
Thank you, sir. Next up, in light of numerous actions taken by a number of bodies of the United Nations which exhibit a deep anti-American bias, we have an executive order prepared for your attention that would withdraw the United States from the UN Human Rights Council, would withdraw the United States from the UNRWA, which is a refugee organization, and would also review American involvement in UNESCO, which has also exhibited anti-American bias. More generally, the executive order calls for a review of American involvement and funding in the UN in light of the wild disparities in levels of funding among different countries that, as you've expressed previously, is deeply unfair to the United States.
So I've always felt that the UN has tremendous potential. It's not living up to that potential right now. It really isn't, hasn't for a long time. It has, there are great hopes for it, but it's not being well run, to be honest, and they're not doing the job. A lot of these conflicts that we're working on should be settled, or at least we should have some help in settling them. We never seem to get help. That should be the primary purpose of the UN, the United Nations, and again, it's got great potential, and based on the potential, we'll continue to go along with it, but they got to get their act together.
What would they need to do, sir, to get their act together?
Well, they got to be fair to countries that deserve fairness. They have some countries, as you know, that are outliers, that are very bad, and they're being almost preferred as countries to those that do their job and are doing a good job, and they have to really, they're going to end up losing, a lot of countries, they're going to end up losing their credibility like other organizations, and then they're going to be nothing. The potential of the United Nations, and not everybody agrees with me on this, the potential of the United Nations is fantastic if properly run. So we'll see what happens.
How much money are you willing to take away from them?
Well, we're taking away a little bit, but we're not looking to take away money. This is so important that we're really, as you know, the United Nations is largely funded by us. But, and it shouldn't be, it should be funded by everybody, but we're disproportionate, as we always seem to be. But it's something that if it ever lived up to the potential, in 10 minutes it would make up the difference. That's the kind of power it could have. Right now it doesn't have that power.
Next, sir, this is a national security presidential memorandum that seeks to impose maximum pressure on the government of the Islamic Republic of Iran. Many of these provisions are similar to actions that your administration took during your first administration. The basic idea here is to have every department and agency, or many departments and agencies in your government attempt to sanction and control Iranian activities, particularly relating to the Iranian nuclear program and the Iranian export of terrorism through support of various proxy groups abroad. And the intent here is to give you all of the possible tools to, I'd say, engage with the Iranian government to ensure that going forward they are less of a malign actor on the world stage.
So this is one that I'm torn about. Everybody wants me to sign it. I'll do that. It's very tough on Iran. It's what we had before. We would have never had the problem. You would have never had October 7th. We would have never had the problem had the election gone the different way, which it should have. But this one, I think, more than made up for it. I think we're doing things, and it shows that more than made up for it, much more historic. The Iran situation, hopefully, I'm going to sign it, but hopefully we're not going to have to use it very much. We will see whether or not we can arrange or work out a deal with Iran, and everybody can live together, and maybe that's possible, and maybe it's not possible. So I'm signing this, and I'm unhappy to do it, but I really have not so much choice, because we have to be strong and firm, and I hope that it's not going to have to be used in any great measure at all. It'd be great if we could have a Middle East and maybe a world at total peace. Right now you don't have that. When I left, you had peace all over the world, and now you have the world is blowing up. As you know, Bibi is coming in to see me later. Others are coming in to see me. We'll see what we can do. But I'm signing this, and hopefully it will be a document which won't be very important, will hardly have to be used.
So what kind of deal would you be prepared to
Well,
make
we're going to
with
see. I mean, we're going to see. They cannot have a nuclear weapon. With me, it's very simple. Iran cannot have a nuclear weapon. We don't want to be tough on Iran. We don't want to be tough on anybody, but they just can't have a nuclear weapon.
Mr. President, are you going to engage in conversations with your counterpart in Iran?
I would.
Do you want to block the sale of Iranian oil to other nations?
Well, we have the right to do that, and that's what I did before. And they had no money. They wouldn't have had the money for Hamas or Hezbollah or anybody else. It could have been solved. This thing, if things went the way they should have, this would have been over long ago. But it's not over.
How close do you think Iran is to developing nuclear weapons?
I think they're close. They're too close. But again, you could go back 4 years. I would have said they would have had it during this intervening period. But they're pretty close, Peter.
And why say that you're unhappy to sign it if it's Iran and their proxies who have threatened to retaliate against you and your team by killing you guys for taking out Soleimani?
Well, they haven't done that, and that would be a terrible thing for them to do. Not because of me. If they did that, they would be obliterated. That would be the end. I've left instructions. If they do it, they get obliterated. There won't be anything left. And they shouldn't be able to do it. And Biden should have said that, but he never did. I don't know why. Lack of intelligence, perhaps. But he never said it. If that happens to a leader, or close to a leader, frankly, if you had other people involved also, you would call for total obliteration of a state that did it. That would include Iran. So I'm signing this, and it's a very powerful document, but hopefully we're not going to have to use it.
Mr. President, if the Prime Minister today were to ask your help in striking at Iran's nuclear facilities to prevent the kind of progress towards a nuclear weapon, would you give him the green light? Either to do it himself or for the U.S. to participate with him?
I don't know that that's what he's going to be asking for. I have no idea that it is. You're telling me. We're going to have a pretty long meeting. We're going to be discussing a lot of things, not only that, but a lot of things. And I'll let you know if the time comes to let you know. But right now, that's not something that I can discuss.
Mr. President, when you said if they do it, they get obliterated. Just to be clear, you're talking about if Iran made an attempt on your life.
Yeah, that would be called total obliteration. And I can't imagine they do that. It should have been stated by Biden, but he didn't state it because he had no clue, as you know, as everybody knows.
What is your vision, actually, for relationship with Iran?
Do you have anything else?
No, that's all we have.
My vision for what?
For a relationship with Iran, and would you?
I'd love to have a good relationship with everybody. They can't have a nuclear weapon. That was the only thing that was very important. They can't have a nuclear weapon. Beyond that, it would be very tough if they insist on doing that. They have some of their leadership, I can tell you right now, and maybe you know it, maybe you don't, but there are many people at the top ranks of Iran that do not want to have a nuclear weapon just for that very reason.
Mr. President, what's your reaction to China's retaliatory tariffs?
It's fine. It's fine. We're going to do very well against China and against everybody else. Right now, they've taken advantage of the Biden administration like I've never seen. I've never seen. The deficit with China is about $1 trillion. Think of it, $1 trillion. They're using our money to build their military. And Biden let that happen. We're taking a lot of fires here. We came back. This is like a different place. The good news is we're doing very well. We're doing well with countries that nobody expected we'd do well with. We are respected again as a nation, maybe at a level that people haven't seen for many, many decades. But when I left, we didn't have any wars. I defeated ISIS, 100% of the ISIS caliphate, and now the world seems to be ready to blow up, but we'll see if we can stop it.
Mr. President, have you reached out to the Iranians about any kind of deal?
Say it.
Have you reached out to the Iranians about any kind of deal to start those
I would
discussions?
reach out. I mean, I have nothing. I see. I'm one that doesn't care whether I reach out or they reach out. A lot of people say, "Let them reach out, sir." And that, to me, it doesn't matter. It's
But
just
that hasn't
it's just
started
talk. But I want to see everybody do well. I want to see great countries, and I want to see peace in the Middle East and elsewhere. We're also working very hard with respect to Russia, Ukraine. That's a bloodbath. It's a total bloodbath. What's going on there is incredible. What's going on with the soldiers, young soldiers being killed by the thousands. I mean, literally by the thousands. And we want to see if we can get that stopped. And I think we've had some very good talks.
Any update on when you would speak to President Xi, sir? Any update on when you would speak to President Xi?
No, we'll speak to him at the appropriate time. I'm in no rush.
Do you,
at the appropriate
do you think that conversation can lend itself to the type of freeze that it meant for the tariffs for Canada and
Well,
Mexico?
we'll see what happens. I mean, well, there's a short-term freeze with Mexico, as you know, and with Canada. But they've agreed to be very, very strong on the border, stronger than they ever were by far, by a factor of about 30. And in addition to that, as you can see, we've been strong because we've had numbers like you've never seen before. I mean, the border is now closed, really closed. And with that being said, we're letting good people come through, and we want good people to come into our country. But the border is closed.
In your talks with Prime Minister Netanyahu today, do you intend to press him about how many deaths there have been amongst Palestinians? Are you concerned about that death?
I talk about that too. You know, both sides mean a lot. I talk about that. I talk about the other side. I talk about everything.
What's your main message to him today during your meeting?
Well, I'm here to listen. He's here to see me, and I'm here to listen. So.
Will you continue to press?
At the right time, I'll give him my
Mr.
message.
President, will you continue to press for this idea that Jordan and Egypt take Palestinians from Gaza?
Yeah, I would like to see Jordan. I'd like to see Egypt take some. Look, the Gaza thing has not worked. It's never worked. And I feel very differently about Gaza than a lot of people. I think they should get a good, fresh, beautiful piece of land, and we get some people to put up the money to build it and make it nice and make it habitable and enjoyable and
Somewhere else.
make it a home.
They don't want to leave, though. Palestinians say they don't want to leave.
I don't know how they could want to stay. It's a demolition site. It's a pure demolition site. If we could find the right piece of land or numerous pieces of land and build them some really nice places with plenty of money in the area, that's for sure, I think that would be a lot better than going back to Gaza, which has had just decades and decades of death.
Where would those pieces of land be?
Well, they
Those
could
Arab
be in
countries
Jordan,
don't want
and they
to?
could be in Egypt, and they could be in other places. You could have more than two, more than one, but you could have more than two. And you'd have people living in a place that could be very beautiful and safe and nice. Gaza's been a disaster for decades.
Would the U.S. pay for that?
I don't think the UN would pay, but I think there's plenty of people that would in the area. They have a lot of money. They certainly have a lot of money. Some of the countries over there, they'd like to see it. I know that Saudi Arabia wants to see peace. I can see that. And many of the countries there, as far as I'm concerned, they all want peace. I think, maybe I'm wrong on this, but I think Iran would like to see peace too. They've had enough. Don't you think they've had enough?
But the leaders of Egypt and Jordan have said bluntly they have no interest in doing this.
Well, they may have said that, but a lot of people said things to me. They said they wouldn't take anybody back in Venezuela, and right now they're flying them right back into Venezuela. And a lot of people, and they're doing the right thing in Venezuela. The Panama Canal is an active discussion right now. They said things about that. And virtually everything that's been said has been incorrectly stated based on the result.
Wouldn't that amount to forcibly displacing those people from Gaza?
I don't think so. I think if they had the opportunity, they'd love it. If they had an alternative to Gaza, they have no alternative right now. I mean, they're there because they have no alternative. What do they have? It is a big pile of rubble right now. I mean, have you seen the pictures of it? Have you been there? It's terrible to live. Who can live like that? And very dangerous. There's shooting all over the place. There's bombing all over the place on both sides. Now, I would think if they had an option of moving to an area, either in a large group or various smaller groups and take care of the close to 2 million people, I would think that they would be thrilled to do it. They have no, when you say about the Gaza Strip, they don't have an option.
To be clear, you're saying they'd be thrilled,
It's very dangerous.
They'd be thrilled to leave Gaza.
Oh, I think they'd love to leave Gaza if they had an option. Right now, they don't have an option. What are they going to do? They have to go back to Gaza. But what is Gaza? There's practically not a building standing, and they're very dangerous. Those buildings are shifting, and they're falling down all over the place, and there's gunfire all over. It's going to be that way for a while.
Mr. President, wouldn't it have made more sense to evacuate people while the war was ongoing rather than now when there's a ceasefire?
Which is what you're talking about?
When it was more dangerous when there were strikes overhead than now.
Well, the strikes could start tomorrow. There's not a lot left to strike.
Exactly.
It's a demolition site. The whole place is demolished. It's unsafe. It's unsanitary. It's not a place where people want to live. Nobody's got. They have no alternative but to go back. If we gave them an alternative of living in a beautiful open place with some, nice quarters there, nice housing of sorts, and we have the money in the Middle East to build that.
Do you support Israelis actually moving back and creating setup buildings?
Not necessarily, no. I just support cleaning it up and doing something with it, but it's failed for many decades. And somebody will be sitting here in 10 years or 20 years from now, and they'll be going through the same stuff, the wars. And they've had civilizations on Gaza, many civilizations on Gaza, and they're buried in the sand.
Secretary,
it doesn't seem to work.
Secretary,
Thank you, sir. On Elon Musk, how often are you talking to him? And have there been ideas that he's brought to you that you've said, oh no, wait a minute, this is going a little too far?
Well, many ideas, but look, he's done a great job. Look at all the fraud that he's found in this U.S. AID. It's a disaster what the people, radical left lunatics, they have things that nobody would have even believed. The whole thing with $100 million spent on you-know-what, with money going to all sorts of groups that shouldn't deserve to get any money, with the money. I'd like to see what the kickbacks are. How much money has been kicked back? Who would spend that kind of money to some of the things that you read about and I read about and I see every night on the news and every morning when I read the papers? Who would spend money for that? I would say this, the people that got all that money, are they kicking it back to the people that gave it from government? No, that's, to me, very, very corrupt. The real question is, how much of a kickback has there been? And one of the things I want to investigate rapidly, because I've never seen anything to this extent, the train that's being built between Los Angeles and San Francisco is the worst managed project I think I've ever seen, and I've seen some of the worst. Billions and billions, hundreds of billions of dollars over budget. In fact, I read where you could take every single person that was going to go on the train and get the finest limousine service in the world and take them back and forth with limousines, and you'd have hundreds of billions of dollars left over. It is the worst thing, and we're going to start an investigation in that because it's not possible. I built for a living, and I built on time, on budget. It's impossible that something could cost that much. And now it's not even going to San Francisco, and it's not going to Los Angeles. They made it much shorter. So now it's at little places way away from San Francisco and way away from Los Angeles. No, we're going to start a big investigation on that because I've never seen anything like it. Nobody has ever seen anything like it. The worst overruns that there have ever been in the history of our country. And it wasn't even necessary. I would have said, you don't buy it. You take an airplane. It costs you $2. It costs you nothing. You take an airplane. But this got started, and if you have to, you drive. You can drive.
Are there other agencies?
They have hundreds of billions of dollars of cost overruns, and it's not even the same project. It's much shorter. It's way outside of San Francisco and way outside of Los Angeles. So we're going to be looking into
Who's
this.
going to investigate that? Is that Doge who's going to investigate the train?
No, I'm doing that myself. No.
Some of these Doge engineers that Elon Musk has helping him are as young as 19 years old.
That's good. They're very smart, though, Peter. They're like you. They're very smart people.
Thank you. Have you met any of these guys?
No, I haven't seen them. They work actually out of the White House. They're smart people. Unlike what they do in the control towers, where we need smart people. We should use some of them in the control towers where we were putting people that were actually intellectually deficient. That was one of the qualifications, is you could be intellectually deficient. No, we need smart people. Some are young and some are not young. Some are not young at all, but they found great things. Look at the list of things. Maybe I'll do it tomorrow. I'll read off a list of 15 or 20 things that they found inside of the USAID. It has to be corrupt. Nobody could approve that. They could only approve that if they were getting kickbacks. You're talking about hundreds of millions of dollars.
And it sounds like you're going to wind down USAID.
It sounds like it. I mean, I think so. Yeah.
So when that happens, which part of the government?
Well, I could see Marco Rubio being in charge, State Department, because they're giving money to. I mean, some of the money is well spent, I guess, but much of it is really fraudulent.
And on the Education Department, why nominate Linda McMahon to be the Education Department Secretary if you're going to get rid of the Education Department?
Because I told Linda, I hope you do a great job and put yourself out of a job. I want her to put herself out of a job. Education Department. So we're ranked number 40 out of 40 schools, right? We're ranked number 1 in cost per pupil. So we spend more per pupil than any other country in the world. And we're ranked at the bottom of the list. We're ranked very badly. And what I want to do is let the states run schools. I believe strongly in school choice. But in addition to that, I want the states to run schools. And I want Linda to put herself out of a job.
Do you think that's something you can do with an executive order, or are you going to ask Congress to do it?
I would like to be able to. Look, if I could give the schools back to Iowa and Idaho and Indiana and all these places that run properly, there's many of them. I think. So if you look at the list, Denmark, Sweden, Norway, believe it or not, China's doing very well on that list, a list of well-educated, where they run their school system well. You have a lot of countries, not surprising names. I think that if you moved our schools into some of these states that are really well-run states, they would be as good as Denmark and Norway and Sweden and some of the other states. And then you'd have the laggards, and you know who they are. I don't have to go to it, but you'd have the laggards, the same laggards that are laggards with everything else, including crime. But even them, you'll break it into systems. As an example, if you went to New York, you go to Westchester County, you go to Dutchess County, you go to Suffolk and Long Island and Nassau and Long Island. You have maybe 6 or 7 locations, and you have New York City, which would include the 5 boroughs. And I think even that would run much better than it does right now. Same thing with Los Angeles or California. You'd have Riverside, you'd break it up into 6 or 7, but most of them would be states, and you'd have one. Like in Iowa, you give it to the state of Iowa, you give it to the state of Indiana, these are really well-run states. They don't have debt, they don't have problems, they don't have any crimes, relatively speaking, to speak of. And you would have education that would be the equivalent of Norway and Denmark and various other places that are at the top of the list. So we're at the bottom of the list, and we're the most expensive. We're at the top of the list when it comes to cost per pupil. We spend more money per pupil than any other nation in the world, and yet we're rated number 40. The last ratings came out, you saw them. So they talk about 40 countries. We're rated number 40. And I say that if we did this, we would go 20, 30 notches up. We could do great. And we would have some of the best districts in the world.
But are you looking to do that with an executive order, sir, or do you need to work with Congress?
Well, there are some people that say I could. I think I'd work with Congress. I think we'd have to work with the teachers union, because the teachers union is the only one that's opposed to it. Nobody else would want to hold them back. Look, we have to tell the teachers union, we're rated last in the world in education of the top 40. We're rated last. We were 38. Now we're 40. We went to 39. We went to 40. We're 37. But we're at 40 now. The thing just came out. That's under Biden. Remember that.
Secretary Rubio announced a deal this week that would allow potentially American citizens who are criminals to be put in a different country. Is that something you're looking to do?
No, I didn't know that he announced that yet, but if he did, it's fine, yeah. We have hardened criminals, horrible people. You see him pushing people into subways. The train is coming last week. Guy walking around, just sees somebody waiting for the train's coming 40 miles an hour, and he gets pushed into the subway. And that happens all the time. These are sick people. If we could get them out of our country, we have other countries that would take them. It's no different than a prison system, except it would be a lot less expensive, and it would be a great deterrent. Send them to other countries. If we could go a step further, in other words, we're talking about getting the criminals out of our country that come in through other countries illegally, right? The illegal migrants, as I call them. Well, we have people that are just as bad as them in our country. If we could get them out, I'd be very happy.
You would pay El Salvador to
El Salvador
house
said that he wanted you to pay a fee for that. Would you pay that?
Well, it's a very small fee compared to what we pay to private prisons.
But under what authority?
And a very, very small fee. I don't know. We'll have to find that out legally. I'm just saying, if we had the legal right to do it, I would do it in a heartbeat. I don't know if we do or not. We're looking at that right now. But we could make deals where we'd get these animals out of our country. And, you know, if you take the shooters, the people that hit old ladies in the back of the head with a baseball bat when they're not looking and walk down the street, the people that you see it, the people that take out a gun and shoot you for no reason at all. If we could get these animals out of our country and put them in a different country under the supervision of somebody that made a relatively small fee to maintain these people, because you know what? These are criminals. You call them hardened criminals. They've been in jail 40 times. There's one 42 times. And every time the person gets out, it's a he. Every time he gets out, he commits another crime within 24 hours. And it's a heinous crime. It's a rough crime. We don't want these people in our country either. We don't want them in our country. If we had the option to get them out and let them be based in some other country at a fraction of the cost, and frankly, they could keep them, because these people are never going to be any good. That person that has been arrested 42 times or 22 times or 17 times and is all in for manslaughter and everything else and only gets out because of a very weak judicial system that only goes after people like Trump. They don't go after the criminals. They don't go after people like this. And they laugh at our law. If that took place, you would have a lot less crime automatically.
So, sir, you're exploring whether to allow this? On Guantanamo Bay, is there enough space there to accommodate?
There's a lot of space to accommodate a lot of people, yeah, so we're going to use it.
Can you talk a little bit
We
more
have
about
it. It's
why?
already up. We have it for nothing. But we can do less expensive and even more secure. We've had other countries come to us saying, we would love to do that. We would love to take your criminals and we'll maintain that. We'll be their jail. And I'm only talking for the most severe cases.
And you're listening to the President of the United States there in the Oval Office. This is tape playback from some comments that he made just a little while ago on a wide range of issues. You continue listening to what he has to say by typing live go on your Bloomberg terminal. But we need to get back to the markets at hand. You are missing a rally. Romaine Bostick here alongside Alex Steele. Scarlet Fu joins us as well with just about 3.5 minutes until these closing bells. And Alex, most of the losses from yesterday being recouped today as a lot of people finding reason to buy that dip.
Yes, but if you look back to the close on Thursday, we still haven't recouped those losses when it comes to the S&P, so there's still a little more ground, about 40 points to make up.
Maybe, but we're about 1.2% off the record high. So it seems like a lot of people are pricing in the fact that there's going to be there's a lot of wiggle room before these tariffs can be considered permanent.
All right, well, markets are up. The VIX is down. Not a whole lot of action in the bond market, though you are seeing a little bit of an embrace with yields going slightly down. We should point out we are in the thick of earnings season. We got a slew of earnings earlier this morning, and we get a slew after the bell tonight. That includes AMD, Snap, Match Group, Allegiant, Enphase, Amgen, Electronic Arts, Mondelez, Chipotle, Juniper Networks, Mattel. And am I forgetting one?
I don't know. Are you? Google?
Alphabet.
Which is
Thanks for listening, Alex.
I was totally listening. Also, they're at a record high, so you have to wonder too. The numbers could be gangbusters, and also the stock is still at a record high.
Yeah, but the stock is trading at a lower valuation than the other Mag 7 companies. So there's a lot of talk about how this is the not necessarily cheapest, but most opportunistic buy of the Mag 7 names right now.
Absolutely. Well, the Mag 7 getting a slight bid here on the day. I should say more than a slight bid here on the day. Not enough, of course, to recoup some of the big losses, but I was looking at the biggest gainers of the day. I mean, you were here after the bell, Scarlett, Palantir. I mean, that is the gainer here. And I think this was, a lot of people were very bearish on this stock.
And given how much it had risen.
Yeah, but given how much it had risen, but based on at least that one earnings report from last night, a lot of optimism here about, I guess, the amount of revenue they're raking in.
Well, I really like the way that they themselves put it, right? Untamed organic growth. I mean,
you can't get more bullish than that, right?
Right, and that's from the company itself. So that just tells you something about how it's comfortable and confident with the kind of projections that are out there.
But go ahead.
I was going to say, meanwhile, Alex Thill, your favorite stock, Estee Lauder, that's probably the biggest decliner today.
Yes, it is.
Because no one's investing in their face.
Yeah, this is my thing, right? You got to invest in your face, and everyone did that during the pandemic, and then apparently it just has like an execution issue in a big, big way, and so they're looking at different options.
Now, they're now going to private label to invest in their face as opposed to brand names.
Sure, I mean, that's going to be cheaper, right? So if things wind up getting hurt, your purse is squeezed, that's going to be easier to digest.
Is that safe? What are you just buying, like retinol off Temu or something?
Definitely don't do that.
I wouldn't go to Temu, but you can go into like other brands.
Because there's going to be a tariff now on Temu, so, watch for that.
Yeah, and we had heard a lot from companies this morning talking about the potential impact of tariffs. PepsiCo, Diageo, if you're an alcohol drinker, they're basically saying, look, this could really kill us here.
Right, but I was talking to somebody on radio earlier, and they were saying that, look, the tariffs are already so high on stuff coming from China anyway that like 10% is not that big of a deal at the end of the day, particularly in certain things like energy and, say, clean energy and clean tech.
And if you're buying a lot of appliances, a lot of people did that before the holidays or in the lead up to the holidays on this expectation that tariffs are probably coming. Certainly that's what a lot of the stores and the manufacturers were telling people to do.
Yeah, absolutely. PayPal down, Merck also down as well. Spotify having a pretty good day as we get the closing bells here in New York as we prepare for a deluge of earnings set to come after the closing bell. That includes from Alphabet. Alphabet closing higher on the day, helping to lift the broader market with the Dow Jones Industrial Average. Look like it's going to add about 135 points or 0.3%. The S&P up roughly 40 points or 0.7%. The NASDAQ Composite and the NASDAQ 100 each up about 1.3%. And the Russell 2000, guys, up about 1.4% on the day.
All right, let's just take a quick look here at the IMAP that shows the sector performances. And the safe havens are the ones leading the decline today. Utilities, staples, and healthcare all in the red column. Energy stocks are the best performers, up by more than 2%, followed by communication services and tech.
All right, just real quick here on the bond market. A totally interesting day buying across the curve. You're looking at the back end down by about 4 or 5 basis points. That front end reversing the decline that we saw yesterday on the sell-off in the front end. The 2-year, you have yields down by about 3 basis points.
Absolutely. Cirrus Logic actually out with earnings. Of course, that supplier to Apple, net sales in their fiscal third quarter coming in at about $556 million. That's above street estimates. And adjusted EPS also looks like a beat. That number at $2.51 a share. The street was looking for $2.04. And you're seeing guidance here for the fiscal fourth quarter. The company saying it's looking at a range of $350 to $410 million. The street on average was looking for $360 million. The shares had been a little bit higher before that headline on the revenue number guidance. Now those shares unchanged. Alex.
And hear this. In the press release, they're talking about how they experienced strong demand in our smartphone audio component, including an amplifier and a 22 nanometer smart codec. So basically part of their business still doing well, the basic part that goes through the consumer.
And just a quick mention here on Cirrus Logic. Also, they make a management change with the appointment of Jeff Woolard as the CFO effective February 24th. Amgen just reported results as well. So let's get you the numbers for those biotech firm. We have Amgen reporting fourth quarter adjusted EPS of $5.31, handily beating the consensus estimate of $5.08. And fourth quarter revenue, $9.09 billion, also higher than the anticipated Wall Street estimate. In terms of the outlook for this year, 2025 revenue will be anywhere from 34.3 to 35.7 billion. That is higher than the consensus estimate.
Alphabet earnings crossing the wire. The shares, the knee-jerk reaction moving lower here on the back of a revenue number for the fourth quarter, $96.47 billion. The street was basically looking for 96.2, so relatively in line with estimates. EPS at $2.15 a share, 2 pennies higher than what the street was looking for on average. Cloud revenue, a miss, $11.96 billion. The street was looking for $12.19. And here's your YouTube ad revenue, $10.47 billion. The street was looking for $10.2 billion. So slightly around what the street was looking for. Caroline Hyde, she's the co-host of Bloomberg Technology. She joins us in studio 2 here. The knee-jerk reaction, Caroline, moving to the downside here. What am I missing?
The cloud revenue is exactly what you hit on, and I think what drags us lower. Cloud is the all-important money spinner in many ways. That cloud has started to bear fruit for Google. Of course, they had been somewhat an also-ran versus the likes of Amazon, but managing to be beefing up if you're not living up to expectations in Google Cloud, when a lot of that is to do with, of course, appetite around generative AI. That's going to be an issue. The revenue excluding paid-for traffic, $81.6 billion, and the estimate for 82.8. They're saying AI-powered Google Cloud portfolio has continued to see stronger demand. So they're trying to talk up some of that growth. But remember, we did see that with Microsoft's numbers. Yeah. Azure coming in weaker than expected. It didn't matter that the overall numbers beat. It was the fact that the growth in the cloud has started to diminuate a little bit.
I just want to point out, they expect to invest about $75 billion in CapEx in 2025. We knew they were going to invest more. They had told us that on the last call. But $75 billion, in perspective, how big a number is that for them?
I mean, Microsoft's spending more than $80 billion. Yeah. I think $75 billion is where they need to be committing to continue to build out the offering when it comes to generative AI model, large language models. This is what's tearing the market apart. Do you need to invest as much as you had previously committed to if we're going to be able to do more with less, that DeepSeek seemed to hint at? But most of them had committed to spending as much, if not more. Remember, Meta had upticked some of their spending to some $65 billion overall. But it does seem that if it's not going to be bearing fruit, where is the return on your AI investment? If your cloud isn't going to be living up to expectations, that 2025 is a significant amount that the market had seen, about $58 billion of spend. And they're coming out with $75 billion. It's a lot more than had been anticipated by the street.
All right, and just a quick mention here of some of the comments in the press release. Sundar Pichai saying that the fourth quarter was strong. We're building, testing, and launching products and models faster than ever. In search, advances like AI overviews and circle to search, increasing user engagement. What's going to be the question that people want to really pin him down on when it comes to the earnings call?
Well, I think antitrust is going to be a key question, particularly here in the United States, and really the fact that he was sat front and center on Inauguration Day. How much is that still going to be a headwind? What about antitrust in China? How much are you going to be embroiled in the tit for tat? Because we know that Android in particular is their big seller in China. Search isn't. But the operating system of phones that everyone uses is a big winner. And I think just more broadly, how much are they able to compete with search competitors? Thus far, Perplexity and the new OpenAI haven't managed to eat into the overall market share when it comes to search. We're all now busy using their own overviews. We're now managing to use a Gemini product. But is there a risk going forward? And do they need to still be spending $75 billion going on data centers?
Just one quick question, though. I mean, why are we seeing this big drop in Alphabet when Meta seemed to get a pass? I mean, they had a big CapEx spend. I know they pre-announced. The ROI on that CapEx spend really wasn't any better than the ROI on Alphabet. So what gives?
I think many had felt that the return on AI investment for Meta was already showing in the advertising pickup. The fact that they're able to be seeing more generative AI use within the advertising creatives and also people coming to them to be able to just get more targeted ads. So they were saying, look, spend with us. Large language models was also a winner in this whole DeepSeek after RAM. But I think, remember, Meta was also at a record high. Alphabet's at a record high. Maybe there's a little bit of profit taking as people have really built in some crescendoing into the numbers ahead of this.
Yeah, record high going into it. Electronic Arts coming out with earnings. It's a third quarter adjusted EPS coming a little bit light, $2.83. And the net bookings coming in a little bit light, or a little bit better, actually. $2.22 billion, a little bit better than estimates. For the full year on the high end, it meets estimates. They see about $7.15 billion on the high end for that. And for the fourth quarter, they see about earnings at 65 cents to about $1. A wide range there.
All right, and let's move on to Mattel, the toy maker, reporting results that beat analyst estimates, both for the fourth quarter as well as for its 2025 outlook. Fourth quarter EPS, 35 cents, beating the consensus estimate by 15 cents. Net sales, $1.65 billion, just a bit higher than what was expected. And full year EPS, anywhere from $1.66 to $1.72, whereas analysts were looking for $1.56. And what's interesting here is that Mattel says it is considering increasing the price of Barbie and Hot Wheels toys to offset the cost of the Trump tariffs.
All right. Well,
my gosh.
Yeah, that's not going to go over well with some kids out there here, or at least some parents, I should say. Meanwhile, Enphase, let's take a quick look at here. The shares higher by about 11% in the after hours trade. Those fourth quarter numbers looks like a pretty decent beat. 382 rounded up to $383 million in revenue. The street was looking for 378. EPS also a beat at 94 cents a share. The street was looking for 77 cents. And if you're wondering about CapEx here, not quite what we're seeing with Alphabet, $8.1 million in CapEx expenditures. That's below what the street was looking for.
All right, just going back to Alphabet for a moment. Shares still dropping pretty fast. We're looking at the Google Cloud revenue was a miss, and that was the big one. But I do want to point out, though, despite that, you get YouTube and Cloud. Is their annual run rate is about $110 billion. That's like, what, 30% plus more growth, Caroline? Can you just put into perspective just how much those two businesses really account for Google and how important they are for Google?
Ultimately, in terms of the growth of cloud and in the particular the growth of market share, this is a company that's having to reorientate its business constantly. The cash cow has always been advertising around ultimately our search businesses. YouTube have become ever more integral, and I think they managed to monetize that. Basically, YouTube in particular, from a TV perspective, is the #1 video source that we all turn to at the moment. So they managed to make inroads there and uptick in terms of their overall advertising. But cloud had ultimately still been this new competitor for them a little bit, and always been trying to make some sort of mind up, whether it comes to now about 10, if you're looking at $12 billion of their overall fourth quarter compared to an $80 billion in total. It's not the cash cow at the moment that search is, but it is the future when we're thinking about how we turn to them for overall compute needs and how they can be vertically integrated. They can give you a large language model. They can also be using their own compute to be training it, and then maybe be selling on a little bit more of that compute.
Right, and cloud is seen as featuring a much smaller base than, say, Microsoft or Amazon as well. So that's the other thing.
And
it
there's
should have
IBM
faster
out there.
growth
There's a
rates.
lot of others. New kids on the block as well. CoreWeave, just think of what they're trying to be able to provide.
Just a quick mention here. We talked about the CapEx. It sees 2025 CapEx at about $75 billion. According to Molly Schultz, our technology editor, the consensus estimate was for $57.9 billion. That is a huge a huge beat in terms of how much more it's going to spend.
Technical.
Yes, exactly, than what a lot of analysts had anticipated.
BI, actually, Bloomberg Intelligence thinks it's basically in line with where they thought it was coming. So I guess the street had different marcations of where they thought the investment would be coming from. But Bloomberg Intelligence, Mandeep Singh over there saying, look, it's as we expected. This number shouldn't be a shock. But I think just to the point of how much we're seeing, remember, Microsoft beat on every single fourth fiscal number, but everyone was worried about the fact that Azure had slowed down by 1 percentage point in a quarter-on-quarter perspective. The fact that Alphabet isn't seeing the growth that we want to see from the new money spinner of cloud is perhaps taking a little bit of wind out of the sails.
This is certainly going to be the story in the cash session heading in tomorrow. We're also supposed to get earnings out of Qualcomm tomorrow as well, and I'm wondering how the chips factor into this. There was a headline on the terminal saying Broadcom rallying in the after-hours trade on the back of Alphabet's CapEx number.
Because Broadcom's going to be, remember, Broadcom is the one that's making everyone's internal chips. A lot of Amazon, for example, is not wanting to be totally dependent on an NVIDIA, trying to be creating their own chips going forward. Maybe Broadcom wins out there. We're all waiting on AMD as well, because that's, of course, meant to be coming out. Lisa Su has been desperately trying to show them as a key competitor to NVIDIA when it comes to data center chips and server chips. Thus far, that market share has not been winning for them.
All right, Caroline Hyde, really appreciate it. Thank you very much for Instant Analysis, co-host of Bloomberg Technology. More earnings rolling out. Taking a look at Snap. Solid earnings beat for their first quarter revenue. They're also going to fourth quarter daily active users also a beat, 453 million, and they see that first quarter revenue, like I said, on the high end of $1.36 billion. So that's a solid beat. And for the fourth quarter, it was also a beat on adjusted EBITDA revenue as well as earnings.
All right, Chipotle here, not necessarily good for the new CEO. The fourth quarter numbers showing comp sales missing 5.4%. The street was looking for 5.7. Revenue also coming in relatively in line with estimates at around $2.8 billion. Operating margins narrowing just a bit to 14.6%. Adjusted EPS in line with estimates. And the company now saying, looking forward here, that it still sees new restaurants in the 315 to 345 range. The street looking for 336.91. The share is down 7% in the after-hours trade.
All right, let's also talk about Mondelez, the packaged food company. Fourth quarter EPS adjusted 65 cents, a penny shy of what was anticipated. Net revenue of $9.6 billion, just a little bit below what the consensus estimate was as well. And adjusted gross margin for the fourth quarter, 31.5%, below the consensus estimate of 33.4%. It sees 2025 organic net revenue at about 5%. Analysts were looking for that range, 5.2%, so a bit of a miss there as well.
All right, we're going to say goodbye to Alex Hill. We'll catch up with her tomorrow here on The Close, but we continue our coverage here, taking a look, of course, at some of the big movers in after-hours trade, and none other posing the biggest drag on this market right now than Alphabet. Those shares down 7% in the after-hours trade on the back of a mixed earnings report that seems to be much less about that top-line number and much more about CapEx and the effect on the bottom line. Brent Thill joins us right now, tech sector leader of software and internet research at Jefferies. He's got a buy rating on Alphabet with the 235 price target. Brent, what was your first reaction to this report?
They missed on cloud, so the growth rate went from 35 to 30, and everyone is expecting AI to help accelerate cloud. We heard from Microsoft, they missed their non-core AI workloads as well. So what's going on? Two of the big three are missing cloud numbers. So that's the first thing. So all eyes will turn to Amazon now. Did they take share? Or are they going to see a decel in cloud? And then I go back to just making the numbers, right? Mm-hmm. This is not a big beat. As you know, Alphabet doesn't guide. They don't give us anything. We're flying in the dark as analysts. So they don't give us any guide, so we're all having to guess. And yeah, I think that's a bigger problem we can talk about. Yeah. But YouTube and core search, 1% to 2% ahead, nothing exciting. Cloud was 2% light. And then you have CapEx a little bit higher, 14.28 versus our 14.23. So, again, it was a ho-hum, not super exciting. It should have been more exciting given kind of some of the tailwinds, given it's a Q4. And again, they don't guide, so we're all going to be guessing. They don't really give you any color on the call. It's probably one of the worst calls for any color of any tech company we cover. So they're unfortunately not going to help anyone on what they see in the pipeline for Q1.
Well, what is that?
Overall, not great.
Well, what does this mean, though? Because, we talk about, at least in past quarters, some of the catch-up that Google was doing with regards to cloud, trying to catch up with, obviously, the behemoth, Amazon, and to a certain extent, Microsoft. In your view, without necessarily knowing what the company's internal guidance is this progress interrupted, or is this progress basically just stalled?
Probably stalled. I'd say they're considered kind of the third call in cloud. Right, you have Amazon number one, 50+% market share. Microsoft with their hybrid approach has a tremendous opportunity and is actually, if you put it in perspective, Microsoft is growing at the same rate, if not faster, in their Azure business, which is their cloud business, as Google, and they're multiple times bigger, right? So this, to me, demonstrates that, again, Microsoft is taking market share. When you look at the growth rate at their size, is incredible that they're growing at that rate. Mm-hmm. And the street was disappointed. They didn't show bigger acceleration for Microsoft. So what I think you're seeing is two of the three big hyperscalers are now disappointed on cloud. What's Amazon going to say later this week?
Yeah, and it's notable that Amazon shares are lower in after-hours trading following these results from Alphabet. The other thing, of course, that we want to point to is the CapEx forecast, $75 billion for this year. Caroline Hyde was just on saying that estimates for how much it would spend were kind of all over the map. There's one consensus estimate of about $58 billion, so this is huge, huge spike above what was anticipated on that front. Where do you sit in terms of how much it's spending and what it's shown? What kind of results it's shown for that kind of spending?
We're in a CapEx war. We're at the beginning of the AI cycle. No one is lowering CapEx. Everyone's raising, right? Meta raised CapEx by 10. Microsoft grew CapEx 97%, but said that would start to slow next year to 10 to 15. Everyone's CapEx numbers are going bonkers, right? And it's the right thing to do in front of what is ahead of us, that we're in the early innings of AI. Mm-hmm. And so you're seeing, again, an ongoing CapEx war. You're going to continue to see good growth this year. I think most are saying, hey, we haven't seen peak numbers, but the absolute growth will start to slow as they have to show an ROI. One tech investor said these companies are starting to look like railroad companies. The amount of money they're having to put out.
Yeah. Hey, Brent,
ROI's not there yet.
I'm just going to interrupt you for a second. We're in conversation with Brent Thill over at Jefferies. We do have some breaking news on AMD. Those earnings crossing the wire right now, and they're looking a little bit more encouraging than what we heard out of Alphabet. EPS in the fourth quarter in line, operating margin in the fourth quarter in line, and revenue in the fourth quarter in line. But R&D expenses going up slightly to 1.71 in the most recent quarter, and the company guiding for the first quarter that its gross margin will be in line with estimates at about 54%, and revenue in the first quarter will be about $7.4 billion. That's slightly above what the street was looking for here. Maybe that's why you're getting a slight pop in the stock here, Scarlett, in the after-hours trade of about 3%.
Right, and also keep in mind that this is a stock that is seen kind of as an also-ran a little bit here, certainly to NVIDIA, and it's down about 1%, a little change for the year, so it's been a laggard. Brent, I want to go back to you and just get your final thoughts here on Alphabet. Given that this company doesn't give any guidance and you're kind of in the dark as an analyst, what is the number one thing that you think they will disclose in the earnings call that might be helpful to you?
I think most of the companies are discussing, hey, how early it is in AI, but what these investments are paying off. What are they seeing in terms of transactions, in terms of excitement around the platform, bigger deals in cloud. Clearly, I think their advertising business is in good shape. I mean, YouTube and search were a little bit ahead, right? The things that kind of worry you are the CapEx up massively and the cloud business, right? And so the cloud business is still a rounding error. It's tiny. It's not the main driver here. So the good news is the flagship business, which is YouTube and search, doing fine. I think just the magnitude of upside wasn't as big as everyone wanted, and that was somewhat disappointing. But this stock is super cheap, 12, 13 times EBITDA, and we still think there's a really bright future. They have more AI behind the hood than they let you understand, and our sources suggest they're gonna roll stuff out from the seventh floor of the basement out that will continue to surprise us and delight us as consumers. So we're still positive on the overall position and where they're going. But yeah, I mean, a slight blemish on the CapEx and cloud is, again, I think the smaller pieces of the business, when you look at the impact, the flagship business is a little bit better.
Brent, always appreciate you taking time for us, particularly on a busy day like today. Brent Thill, tech sector leader of software and internet research at Jefferies, one of the best in the business. And when we come back, we're going to get another best in the business with Daniel Newman over at the Futurum Group, a breakdown of those earnings that we just got from Advanced Micro Devices. This is Bloomberg. More breaking news, this time in the crypto industry, this time involving Peter Thiel, Bullish Global, the crypto asset exchange operator backed by Peter Thiel's company, said to weigh an IPO. This according to people familiar with the situation that our Bloomberg reporters have spoken to. They do stress that deliberations are still ongoing and details of that offering could potentially change. Scarlett?
All right, we'll continue to keep an eye on that. We're also watching, of course, shares of AMD, shares of shares of Alphabet. All the A companies are getting me confused here. And of course, the big one is Alphabet, given that it's declining after disappointing cloud sales were a drag on revenue. Daniel Newman is here with us. He is CEO of the Futurum Group, and he's going to talk about that along with some of the other companies. But when we look at Alphabet, it's the cloud revenue that is grabs your attention here. $11.96 billion versus the consensus estimate of $12.2 billion. And we also saw Microsoft coming in with some disappointing Azure numbers, at least as it was received by the market. What does this mean in terms of were investors just too optimistic on the kind of cloud growth that these hyperscalers are capable of putting together?
Yeah, hi, Scarlett. I think Microsoft tipped us off last week that even a small miss on that number, you could be really solid across other parts of the business, and that the market was going to react pretty negatively to it. And I think right now it's all about this digestion, because we hear about AI. We're hearing about all this CapEx investment. And we're thinking this should be translating to the platform companies, to the application companies. And what we're still seeing is that most of the revenue that we can really attribute is being left with just a few names. So when we look at a company like Alphabet, Scarlett, I think what we're really trying to see here is Why is it not accelerating faster? Having said that, I've been very impressed with Thomas Kurian and the team. I mean, they took that to profitability. They're up in that 30% plus growth. And, they've really made Google competitive over the last 8 quarters.
Has anything changed from, I guess, last Monday or a week and a half ago when we learned about DeepSeek and the potential for any sort of pullback in that CapEx spend? And I ask that in the context of the earnings that we just got out of AMD, which was obviously trying to play catch up with the rest of the folks. And I wonder, is that trade over?
It's been a really difficult week to digest. If you're like an investor and you've been looking at this situation, first thing you hear is DeepSeek, nobody needs NVIDIA anymore. And then you're like, wait, hold on a minute. Yeah. And then you're like, DeepSeek, maybe we don't need as much NVIDIA. And we've gone through this whole kind of circus over the last week, but the CapEx guys, whether it's been Zuck, whether it's come from Satya Nadella and the team at Microsoft, or whether it was the $75 billion number that came today, suggests to me that nobody is sold on the idea that sort of the imitation approach from China is going to alleviate or replace the CapEx spend.
Speaking of NVIDIA, AMD came out with the results, and the reception to AMD's results were much more positive. The stock is up in after-hours trading right now. Actually, it's now turned down. But sales for this quarter will be higher than what analysts had anticipated. Is it the firm number 2, or is that number 2 spot still wide open?
I think they are firmly placed as the number 2 in this sort of flexible AI accelerator. And the reason I say flexible AI accelerator, this is something that competes directly with that sort of NVIDIA portfolio. They're thinking about it through the software, through the frameworks, and the hardware. The problem is, if you look at what Google is doing with the TPU, you look at what Microsoft is doing with Maya, you look at Amazon, they made big investments with Trainium, Broadcom, Marvell. These companies are all building these custom AI chips. So then there's this question mark is the market really just for 2? Or is the market really for 2? And then anyone that's willing to partner with Broadcom or Marvell with enough scale, so Meta and all these companies, they're building their own. So I like AMD as the number 2, but 5 or 6 billion versus 100 plus, it's not making the dent that I would hope. But it's encouraging. We need competition.
Well, this goes back then. I mean, we talk about Alphabet and some of the companies that are supposed to be the beneficiaries of this. As an investor, are you more intrigued by those companies that are going to develop their own chips and their own technology, or do you just bet on the ones that are relying on NVIDIA and obviously paying whatever Jensen decides he wants them to pay?
Yeah, I think we want it to be a bit of a zero-sum game. I think if you look at, so let's stick with Alphabet for a minute. Alphabet has spent well over a decade. They bought DeepMind, Google Brain, invested and built the TPU, trained Gemini on their own hardware, but of course has a very strong and historic relationship with NVIDIA as well. I think it's about an and, Romaine. I think what's going to happen is these companies, the big ones, so we mentioned Metas and Amazons, that are customer zeros, investing in a lot of their own technologies, they're going to definitely look to go down both paths. Spent time with Arvind Krishna today at IBM, and he did their big investor day, and they've really stuck on their own path. They've not committed to anyone else, and they've taken their business from 0 to $5 billion in Gen AI revenue in just 6 quarters.
So, Dan, as you look ahead to Amazon's results later on this week, how are you thinking about how we should assess the progress and the development of its cloud business? Yeah, so AWS, its cloud business feeds that entire machine. Most of the op inc is what pays for the entire business and its growth. AWS kind of was seen coming out of the gates on AI as a little bit behind. You saw Adam Selipsky turned over. Now Matt Garman is in charge of that business. The growth got to be a little bit smaller. It was a law of large numbers situation, though, because the business was so much bigger. But I think with Alphabet and now with Amazon, Microsoft's at least come out and been bold enough to say we have, $13-ish billion. I want to hear that. And if I'm an investor, I want to hear that. All right, Dan, always appreciate you coming on the program. Great to have you in person. Daniel Newman, CEO of the Futurum Group, as we break down the flurry of tech earnings, a conversation up ahead with the managing director over at Redpoint Ventures. This is The Close on Bloomberg. All right, we've been hit with a tide of earnings from Alphabet to AMD. Let's get you a roundup of some of the notable movers beyond those names and bring in Bloomberg's Bailey Lipschultz, Jess Menton, and Emily Grafeo. Bailey, get us started. You're keeping an eye on Mondelez, the food company.
It is rough, Scarlett. Stock down more than 3.5%. And this is after it closed at the lowest level since October 2022. Missing expectations when you look at their forward guidance on EPS, falling pretty well short of what Wall Street analysts were looking for. And also calling out the fact that not only are they dealing with a stronger dollar, they're uncertain about what tariffs and any retaliation could actually mean for their bottom line. That's not included in that weaker than expected guidance. Another thing to keep in mind, organic revenue growth for the fourth quarter, 5.2% overall, missing expectations of 5.87%, North American organic revenue only up 0.4%. Estimates were for more than 3.5% growth. So a pretty brutal quarter of earnings for the owner of Oreos and in the entire snack food, packaged food space that we've seen a little bit of weakness. But Jess, you're also seeing weakness with maybe a little bit heartier food.
That's right, Chipotle. So looking at this after hours, down close to about 5% here. So we're looking at the fourth quarter. When you're looking at same-store sales, the expectations were supposed to be around 5.7% for that quarter. Actually came in just shy of that, around 5.4%. But then also looking ahead 2025, they see the same-store sales outlook being in the low, mid to single digits here. So that's why you're seeing that stock pressured, because for context, this stock, especially when you're thinking about other companies that are in the restaurant space, had been outperforming those if you're thinking about McDonald's as well as Starbucks. And of course, Brian Niccol was the former CEO of Chipotle, left in August. So on this earnings call, be the first one for Scott Boatwright, who took over the helm for this company back in November. So there's going to be a lot of questions, especially when it comes to technology and what they're going to do with certain produce. Of course, also when it comes to Chipotle, you're going to ask questions about avocados, because one of their primary sources that they get it is from Mexico. Will they make any sort of comments about tariff-related issues there? But those are the main things we're watching here. But I know Emily's looking at network equipment makers right now.
Yeah, I feel like we have we have food, and then we also have tech, because I'm looking at shares of Snap Inc., the social media company, popping at over at least about 11% right now. They upped their first quarter revenue forecast. They now see revenue $1.3 billion to $1.36 billion. That slightly topped estimates. They also see daily active users for the first quarter at 459 million, which beat estimates just slightly. And they also upgraded their year forecast. When you look at the fourth quarter, it was also a beat on revenue, up 14% year over year. Not seeing so much right now in what they're talking about in terms of their AI strategy, but certainly that is of the focus right now for any tech companies, any social media companies. How are they adapting to the developments when it comes to what we're seeing in China? How can these U.S. companies pivot? So I'm definitely going to be watching that going forward. But overall, right now in the post-market, Snap is higher.
All right, our thanks there to Emily Grafeo, Jess Menton, and Bailey Lipschultz. A nice recap here of some of the other earnings out there. Of course, Alphabet, that is the big one that will have the most important drag on the market tomorrow. Those shares down 7%, and it's raising a lot of questions here about what the next development is for AI. Where are the opportunities to be found? We want to bring in our next guest. Her name is Erica Brescia. She's managing director at the VC firm Redpoint Ventures. She's also the former COO over at GitHub. Erica, thanks for being here on the program. Taking a look at kind of what your funds have, and more importantly, what they're targeting, the idea of where that AI puck is sort of going and where those opportunities are. We focus so much on those big names, and I do wonder, are there opportunities beneath that initial layer, beneath the Microsofts, the Amazons, the NVIDIAs? There's got to be life out there somewhere beyond those names, right?
Oh, absolutely. And by the way, thanks for having me today. I think this is one of the most exciting opportunities that I'll probably have in my entire investment career, because of the opportunities to innovate for early stage technology companies. And if you look across the entire stack, there's innovation happening at the chip level, at the infrastructure level, all the systems that you need to power AI applications, as well as at the application layer. And I'll tell you, we are seeing incredible momentum and velocity in our portfolio, companies beating quarterly expectations on the backs of AI and building AI into their applications. So there's a huge amount of opportunity, and we're really at day 0.5 and what's to come there.
Can these smaller companies, can they stand up to the larger ones, or is this completely sort of divorced from that? I guess the question is, do they need to have, an $80 billion CapEx run rate on AI the way that an Alphabet or Microsoft or Meta would have?
It depends on what you're building. You know, a lot of companies are building on top of those platforms, right? They're leveraging the CapEx investments that the big companies are making to build AI applications. And, you know, I'll give you one example from our portfolio company called Qualified, a bunch of execs out of Salesforce. They're seeing tremendous growth in their product, which is in the GTM space, helping companies close more deals more quickly because they've built an AI SDR. And again, beat their forecast for the quarter. We're really excited about that one. And that's just one in a lineup of stories. We're seeing companies like Abridge in the medical space that are doing medical transcription for doctors growing like wildfire. We're seeing a company like Trunk Tools, which does AI for construction, right? Completely reinventing the construction company. All of these companies are building on top of the platforms that the foundation model companies and the GPU providers are creating. And I think, you know, what we've seen lately with DeepSeek and the constant new innovation just means that the cost to build these applications and not just train the models, but build AI applications and put them into production is coming down. Yeah. And that's exciting because it's creating a ton of opportunity for these companies to build new products and bring them to market.
One thing that's surprising about this age of AI is how some legacy tech companies are also seeing an opportunity to prove themselves once again. You're seeing Oracle and IBM also benefit from AI demand. And I'm wondering whether these tech startups that you invest in, that you just mentioned, are they logical bolt-on acquisitions for some legacy tech companies?
I mean, anytime you have a Cambrian explosion of new companies and small, lean companies that can innovate very quickly, that can try new things, you're going to have a bunch of big buyers that are going to be looking for opportunities to, you know, accelerate their own innovation and bring fresh talent into their companies. So I do think we'll see a lot of acquisitions, but I also think we're going to see some generational new companies that are created, that are built AI first, AI native. And they have some huge advantages when they are able to approach the market that way without some of the legacy technology and even legacy pricing models of some of the incumbents.
Okay. I know that within your portfolio, you have a European company called Mistral. It's in your European portfolio as well. Thinking about DeepSeek and how it kind of emerged from out of nowhere, a lot of people, you probably were aware of it, but so many people were not aware of it at all until that Monday. If a Chinese startup like DeepSeek can kind of suddenly emerge, is it possible that we could see a European company also vault to the front as well? Because they don't face a lot of the restrictions that Chinese companies do, for instance.
Well, I mean, I like to think that Mistral was the first one and DeepSeek is maybe the Mistral of China. DeepSeek certainly did not catch anybody who's really been following the market flat-footed. They're using a lot of techniques that Mistral and other companies in our portfolio like Poolside use to build their models. And I mean, I don't mean to underappreciate the accomplishment of the DeepSeek team. It's incredible, right? They've done a lot. But there was nothing in their techniques that was surprising or unknown to the market. And I think we're going to continue to see innovation from throughout the world coming from companies that are leveraging the inventions of others, are training on top of their data and their models. And that's one of the magical things about, open source and open weights and data being out there is that companies can continue to innovate on the backs of each other throughout the world. It'll really benefit consumers and benefit app builders.
I'm curious. I mean, you brought up open source, and obviously, particularly with your background in GitHub, obviously, and your background at Redpoint too, open source is certainly your jam. And we saw that divergence last year in some of those big AI companies, some basically taking that open source route and others saying they wanted to keep it proprietary. Overlay that with what we learned out of DeepSeek, which of course is open source as well. Is there inherent conflict between those two models, or can they coexist?
I mean, look, we saw the same thing with operating systems, right? We have Linux, which, is the most popular operating system in the world now, fuels, everything around us, fueling this broadcast, I'm sure. And you also have Microsoft, which is not an open source operating system. We're going to see the same thing at the AI layer. And we're going to see fantastic innovation and improvements across both open source and closed source models. Obviously, I'm a huge fan of open source. I've also served on the board of the Linux Foundation for almost a decade. And I think open source brings a huge amount of innovation and also opportunity throughout the ecosystem because so many people around the world can benefit from it. So it's fantastic to see the innovation happening in open source, but that doesn't preclude closed source companies from being successful, and I think we'll continue to see growth on both fronts.
All right, Erica Brescia of Redpoint Ventures, really appreciate your joining us today and giving us your take, kind of putting everything in context for us here. And of course, we do want to give you a quick recap of, again, how these big companies are trading in after hours the session right now. You have Alphabet now down about 7.5% after its cloud sales fell short of expectations. We saw something similar with Microsoft. The focus now turns to Amazon, which will be reporting later this week. AMD's results providing a bit of a window into AI spending, and right now, even with its first quarter sales coming a bit higher than expected, the stock is down about 4.3% right now.
Meanwhile, you see Snap getting a pretty strong bid here in the after hours trade, up 11% here. Strong ad revenue, strong subscription growth. Meanwhile, Chipotle, which is one of the biggest decliners on the day, seeing less than stellar results there, down about the 5% here in the after hours trade. Of course, they have a new CEO. You need to give this guy a little bit of time, but he is coming into a situation where growth is slowing. We'll be back in a moment. This is The Close on Bloomberg.
I think the big problem with 25% tariffs on Canada and Mexico is they're part of an integrated economic trade zone. The onshoring, friendshoring that's been taking place over the last 10 years has really integrated the Canadian and Mexican economy with the U.S. economy. If you all of a sudden you put 25% tariffs in place, you're blowing up that economic integration, which has actually had quite a few benefits for the United States.
And that was the former New York Fed president and Bloomberg Opinion columnist Bill Dudley on with us last hour on how President Trump's tariffs could impact the U.S. economy. I'm pleased to say joining us now is Richard Clarida, Global Economic Advisor at Pimco and former Fed Vice Chair as well. Rich, it's great to see you here in person. Thanks for joining us.
You bet.
Economists seem to be pretty much in agreement that tariffs will be inflationary. Donald Trump has finally admitted that Americans may feel some pain. What would have to happen in terms of policy or economic conditions for Trump to be proven correct that tariffs will be, provide a little bit of pain, cause some pain, but not be massively inflationary?
Well, there's certainly a lot of uncertainty. And the big question is, are tariffs a bargaining chip or a battering ram? If tariffs are a bargaining chip, we may not get much inflation. It's the art of the deal. The other scenario is they're a battering ram, prices go up. The real question for the Fed, which I'm sure we'll get to, is if prices do go up because of tariffs, is that inflation or a one-time increase in the price level? And I think they'd be inclined to think of it as a price level, but they need to be very sure that the public didn't think it was inflationary.
And how do you gauge that? How do you determine whether the public thinks it's inflationary?
Well, you look at a lot of surveys. You look at bond market indications of expected inflation. You look at whether or not companies that compete with imports are starting to raise prices. And so the message I took away from the Fed last week is Jay Powell and the committee is very attuned and attentive to monitoring that risk.
There's been a whole debate here about the wait-and-see approach by the Fed. And they've made that clear, not only Jay Powell, but several of the other members. I think this week we heard from Bostic, Daly, Collins, and a couple others who've kind of said that. The question is there a case for the Fed to be more proactive in this situation, given that we do have some sense of what the impact could be?
I think it's a close call, but if I were still in the building, I would probably side with the chair and the people that you mentioned, simply because I think there is a plausible scenario where the tariffs really are more of a bargaining chip than a battering ram, in which case it would be a mistake to pivot to a tighter policy that was not needed. But look, it's a challenging situation, and in some ways more challenging than the situation that the Fed navigated during my time there in 2019, because initial inflation was lower and the tariffs were less than are being discussed now.
Well, let's flip the question then a little bit. We're talking about an economy coming into this year that's relatively strong. Strong
sure.
GDP, strong consumer growth, inflation down, not necessarily at the Fed's target, but manageable, right? So even if we do get the worst of what Trump is promising, can the economy withstand that even without Fed action?
I think so. I think that the details would be important. Are there going to be exemptions, as I mentioned? But I do think that unemployment's near a 50-year low, very strong, robust growth. The U.S. is really one of the only economies that's above its pre-pandemic trend. So a lot of positive momentum, and that would be our baseline case, that even with a pretty significant increase in prices due to tariffs, the economy probably can withstand that.
We're focused so much on tariffs and what they might mean for inflation. What about tariffs and the job market? Because President Trump's ultimate goal is to bring manufacturing back home, and that would be a job creation story. What's your take on how that works? Do tariffs encourage job growth, or do they perhaps lead to more job reduction?
Well, it's a complex question because much of what we import now is an intermediate input, capital goods. So, way back when you imported consumer goods, people think of toys at Christmas, but now a lot of imports are really into the production process. So if you increase the price of those inputs, you discourage investment, potentially employment, and that's why it's a more difficult calculus now. And obviously it takes time to reshore and bring factories back. Perhaps some quicker opportunities to do that vis-a-vis Mexico and Canada as they may renegotiate the trade agreement. But from the rest of the world, that's a long process.
Okay, so it's not something we're going to find out right away.
Don't think so.
You mentioned you were vice chairman of the Fed during the first Trump administration. Are teams at the Fed entering new inputs into their models every time Trump threatens to impose a tariff on a country, or do they actually wait until it goes into effect, like with China, for instance? Take us inside the factory and show us how the sausage is made here.
Well, I can only comment during my time there, and of course, all the staff briefings with a 5-year window are now available, so people can go back and look at the briefing books I was reading in 2018 and 19, and what they tend to show is that the Fed staff will typically look at scenarios. They won't pick one outcome. They'll look at a range of possible tariffs and retaliation, and they'll give the committee essentially a range of possible outcomes and offer their professional assessment of the most likely outcome. But it's still early days, as this week showed us, right? So I woke up Monday morning thinking 25% is a done deal. And then I went to bed seeing that, at least that can was kicked down the road for Mexico and Canada. So a lot of moving parts right here.
And so you're going to have to probably change your model, change your scenarios, maybe once we get to March 1st, depending on whether Trump follows through or they strike another deal here. There are a lot of other factors going on, too. We've seen the moves in the Treasury market. We've seen the moves in the dollar, at least the strength that we saw in the dollar, at least prior to today here. That has to be a big input into whether the Fed thinks the economy is going to be resilient enough to withstand this.
It certainly is. The dollar, of course, responds to a lot of things, but it has been responding in recent months to the threat of potential tariffs. You've seen a big move, for example, in the dollar versus Mexico and Canada. So that's clearly the effect. The bond market's paying attention as well. Now, bond prices reflect not just trade, but also growth prospects, deregulation. And then finally, of course, the stock market yesterday morning when I woke up wasn't thrilled about the 25%. Indeed, I think the S&P at one point was down nearly 2%, and then that all reverted later in the day. So those will all be relevant to the economic forecast.
So I then want to circle back, and I think this is the comment that Scarlett made towards the top about perception, confidence, whether it's consumer confidence, business confidence. Even if we don't get these tariffs in the full that Trump has promised, there's a lot of uncertainty in between. And I do wonder if that can dampen economic activity, just the fear.
And indeed, and again, this is in the public domain now, but that was a real focus of the briefings that I and others were getting, which is that trade uncertainty or trade policy uncertainty in and of itself is a macroeconomic factor. And we really did see it in the data in 2019. Tariffs were only then being phased in, and were pretty modest all in, but there was a lot of uncertainty about what they would be, and that did show up, especially in manufacturing activity.
We know that
I think it's in everyone's interest to resolve this uncertainty as soon as possible.
Certainly. But we know that President Trump looks at the stock market as a scorecard for his policies, and the S&P 500 is just about 1.2% shy of its record high. Rich, what do you think? What else should he be looking at or listening to gauge the effectiveness and the reception of his policies?
Well, I mean, he has a good set of advisors, so he should listen to them. I know Kevin Hassett very well and some of the rest of his team. And again, I think they have an ambitious plan, not just in terms of trade, but in terms of fiscal policy and deregulation. And all these do need to fit together, and I think over time can fit together. So I think at these early days, I would really, and I'm sure they are focused on, the sequencing and how all of this program will fit together.
Rich, always a great conversation.
Thank you.
Rich Clarida, Global Economic Advisor at Pimco and former Vice Chair at the Fed. Before we go to break, Match Group, those shares down 8%. They have a new CEO, Spencer Rascoff. They poached him from Zillow, replacing Bernard Kim, who had been struggling to end a decline in subscribers, particularly on the Tinder app. Overall, the earnings are out, and they were down. The company now saying that 2025 revenue will be down -3% to +1%. You see those shares down 7% in the after hours trade. This is The Close on Bloomberg. Here's what you need to keep your eye on over the next 24 hours. Earnings before the bell out of two big companies.
Yeah, Disney is likely to report double-digit increases in adjusted earnings, so watch that one, and Uber as well.
And aftermarket, we're going to get quite a few names here that could really move the market, including Qualcomm.
Qualcomm is definitely a big player here, especially if AI moves towards the devices. That's its sweet spot, right?
Yeah, we're also going to hear from ARM, MicroStrategy. We're also going to get earnings out of Ford, and we're going to hear from the CEO of Ford, Jim Farley, right here on The Close tomorrow.
Looking forward to what he has to say about the EV program. And of course, we look ahead to Fed speak, although Thomas Barkin, not a Fed voting member this year.
You're looking forward to Fed speak? All right, we're going to look forward to the ADP employment change at 8:15 a.m. tomorrow. We also get that trade balance data at 8:30 a.m. What's that going to tell us?
That's a new scorecard right now because under President Trump, he looks at that very carefully, and it's estimated to widen to $96.8 billion in December.
All right, well, a lot could happen over the next 24 hours, and you want to be here watching The Close when it happens. Join us tomorrow. In the meantime, stick around. Balance of Power is coming up next, right here on Bloomberg.